Volume is low, the price action mild, coming off the strongest week of the year for U.S. equities. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
Welcome back, by the way.
Thank you.
Did you miss us?
I did.
He did not. I'll say that.
You're
He definitely
right.
did not. All right, I'm Alex Steele. We're kicking you off to the closing bell right here in New York. So S&P down by 0.1%. But not only did we have a super strong week last week, but here's a good stat for you. Last week, we saw the most amount of S&P 52-week highs in nearly 3 years. Talk about your broad base. So no doubt, we're going to see a little bit of a pause today. A couple individual names that are definitely interesting to keep in mind here. Lucid seeing a nice pop, getting a $1 billion lifeline from Saudi investors. United Airlines, we'll talk about this throughout the next couple hours as well, down 4% on a Bloomberg News article that you might have the FAA restricting some of its routes. We'll get to that in just a moment. We also had a pretty good 2-year auction. I have to say, the bid to cover was strong. The yield was a little bit lower. We get a 5-year tomorrow, and then we get a 7-year later on in the week as well. So we are still seeing strong demand, although yields are up on the front end by about 3 basis points remain. Yeah, that's the setup here as we count you down to the close. 2 hours to go until those bells here. Chip stocks, AI stocks, crypto stocks, among some of the bigger bright spots out there here on a day where about 7 of the 11 S&P sectors are still stuck in the red, coming off of that record run last week. The leading sector today, that would be energy. WTI crude right now holding above $80 a barrel with that 50-day moving average exceeding the 100-day, a bullish chart pattern known as the Golden Cross. Analysts over at Goldman say this might actually be the start of something more. They forecast raw materials to return 15% this year as interest rates fall, manufacturing starts to recover around the globe, and geopolitical risk persists. The Bloomberg Commodity Index right now on pace in March to end a 7-month-long losing streak. That's the longest stretch of monthly declines going back to 2018. Now, as for equities, overall, 2 of the most pessimistic strategists out there say the stock rally looks a little spent, and it could reverse if company earnings start to disappoint. Morgan Stanley's Mike Wilson saying it's hard to justify higher index level valuations given that 2024 and 2025 earnings forecasts have barely budged. JPMorgan strategist Mislav Matega echoing that sentiment, expressing concern that profit growth could underwhelm. Mike Wilson expects the S&P to end the year at 4,500. JPMorgan sees a drop to 4,200. That's almost 20% below today's levels. But that dour attitude really goes against the grain of not just other Wall Street banks, but against the grain of economic vibes as well. The latest Bloomberg survey of economists was decidedly more upbeat than just 6 months ago, with predictions that the labor market will remain strong, and that will fuel consumer spending and growth without derailing the Fed's fight against inflation, Alex. I like the vibes.
Yeah.
Okay, so you get the vibes versus the calls. And that leads me to did you see the Goldman piece out today?
I did.
Yeah, so it has the various,
Yeah.
Tell me.
Yeah, go ahead.
Oh, the various ranges, right?
Yeah.
They're like, okay, we're still sticking to 5,200. We got ranges. One on the high end was 6,000. And this becomes if valuations of mega cap tech continue to expand. And this kind of shows it can reach 6,000 if you get the price to earnings ratio of 23 times. And that's how we get there. That would be a somewhat of a re-rating than where we are right now. But as Romaine pointed out, it's been energy and materials over the last month that have really led the S&P higher and then have outperformed. So do we really need tech? Do we really need S&P at 6,000? Do we really need those Fed cuts? Or can the real economy, and you're also mentioning commodities overall, if that keeps performing, can we wind up seeing an S&P that holds up pretty well, Romaine? Yeah, that is the big question, and one we're going to pose to our first guest as we kick you off to the close here on this Monday afternoon. David Lebovitz joining us right now, global market strategist at JPMorgan Asset Management. David, great to see you here.
Thanks for having me.
Let's start off here with those economic vibes. Are you feeling them?
So I would say that the economic data has certainly been more resilient than a lot of people expected. I do think it's important to take a step back and recognize that we have seen kind of a subsequent deceleration in the overall pace of growth. But with Atlanta Fed still tracking north of 2%, that's above our estimate of trend. And that's pretty good given what people have been calling for over the course of the past 12 to 18 months.
So put that against the backdrop of what we heard out of Jay Powell last week. And, of course, all right now of the parlor bets as to what type of rate action we're going to get this year and whether it's going to live up to market expectations.
So I think what's very interesting about where we are today is you have the Fed saying one thing, the market saying the same thing, and a lot of investors confirming that, looking for 2 to 3 cuts between now and the end of the year. What I heard from the Fed is, one, they recognize that they need to maintain their credibility. And so they didn't want two kind of noisy inflation prints to knock them off course and begin to undermine the confidence that the market has in their ability to get inflation back to 2%. The other thing I heard from the Fed is that they're not necessarily prioritizing getting inflation back to 2%. They're focusing more on the growth side and the employment side more specifically, which I think is an interesting dynamic because to an extent that could bring a Fed put back into play. And I think that's part of the reason why you're seeing risk assets and particularly equities perform so well in reaction to that news.
So you're vibing on the economy, and then for the equity market, right, just as we kind of want to understand how much more upside there is, you get that potential Goldman call, right? You could get a 600 if the mega tech stocks go that way. Morgan Stanley upgrading the energy sector to overweight. Where do you want to be overweight right now?
So the first thing I would say about the equity market today is, coming into the year, the fundamentals we thought justified a price target of about 5,100, and we've clearly moved past that. But I don't think that this is a world where you necessarily want to fight the tape. And to the point that you both just made, you are seeing that broadening out of the rally. Number of sectors, industrials, financials, so on and so forth, seeing an increasing share of names above those 52-week highs. And so
I'm curious though, just on that 5,100 or whatever the target is, anything above 5,000 at this point. When you start hearing people saying 4,200, 4,500, you're talking about a pretty dramatic drop in prices. Is there a scenario where you would even see that playing out in the short term?
So I think something would need to go actively wrong, and I think it would probably entail information that we don't have at the current juncture.
Gotcha.
Some re-escalation of geopolitical risk, something goes sideways, perhaps with respect to a treasury auction or something like that. But given the way we see things, we think modestly above trend growth and a gradual rebalancing in the economy is very much in the cards for this year. And so I don't think that this is an equity market that you want to short, and I think you can begin to lean into those more cyclical parts of the market, the industrials, the materials, the energy, the financials, and not just rely on mega cap tech. That's not to say that we don't like mega cap tech. Any business that can self-fund and compound cash at those type of rates is certainly attractive as a long-term investment, but we are trying to be a little bit more tactical and embrace some of those other parts of the market that may not be trading at such a valuation premium.
So rotation.
Exactly.
Basically what you're saying. Overall, what's the signal to sell?
So I think the signal to sell, to me, would be some sort of more definitive deterioration in the labor market. And, labor markets have been very well behaved. Claims have stayed low. You've seen them edge up ever so slightly. Job openings are beginning to come down. The unemployment rate went up by 20 basis points, although I wouldn't turn a mouse hole into a molehill. I think that you would want to see payroll growth slow significantly, the unemployment rate begin to rise, and some of the survey data really begin to roll over. Because it's interesting, right? Employment in the PMI sub-indices, just as an example, was relatively resilient even during periods where people were asking some questions about broad-based labor market health. And so I don't think you want to hang your hat on any single data point. To me, this is a time to embrace the mosaic and try to see the forest for the trees.
David, always great to talk.
So poetic.
Yeah.
He was there on a Monday.
Oh, this is why we love him. David Lebovitz there, global market strategist at JPMorgan Asset Management, helping us kick off to the close here, a discussion about the economy and equities, as well as what's going on in the rates and FX market. No shortage of Fed speak out there today. A breakdown of commentary from Raphael Bostic, Lisa Cook, Austin Goolsbee, Stephen Englinger are going to be joining us over at Standard Chartered Bank.
Plus, Cleveland Cliffs awarded more than $575 million in the Biden administration energy investments. We discuss what that money means for the company with the CEO, Lourenco Goncalves.
And, of course, another CEO in the spotlight, David Calhoun over at Boeing, planning to step down at the end of the year. The board cleaning house already. A discussion here on what's next for the biggest plane maker in the world. That's coming up just a bit, right here on The Close on Bloomberg.
The risks to achieving our inflation and employment goals are moving into better balance. The risk of easing monetary policy too soon or too much is that it could allow above target inflation to become entrenched and halt the progress that we have seen.
That was Federal Reserve Governor Lisa Cook joining a chorus of Fed speak from the likes of Raphael Bostic and Austin Goolsbee, urging caution on the timing of rate cuts. I want to bring in now Stephen Englander, a global head of G10FX research over at Standard Chartered Bank. So careful policy approach, like that's what has stood out to me. That was a quote from Lisa Cook, careful policy approach. How do you express that when it comes to then the dollar?
Well, I think the market, before it sells the dollar, wants to see that the dollar is kind of on the front lines of cutting. And, with the S&B cutting, the Swiss National Bank cutting last week ahead of everyone else, discussion about whether Bank of Canada, ECB are going to be cutting and when they might cut, the market's unwilling to sell the dollar on this. We do think that if everybody cuts at the same time, it's going to be very risk-on. And that kind of risk-on environment tends to be dollar negative, not super dollar negative, somewhat dollar negative. But for the dollar to be really soft, dollar has to go faster than everyone else and reduce those rate differentials. And so far, that doesn't seem to be what the market is seeing.
So for the dollar to get materially weaker, we need the Fed to cut harder and faster than other central banks. And you don't see that really happening.
Well, the market doesn't see it happening.
Okay.
We're a little bit on that side. We see 4 cuts this year. We think they're going to cut in June. There's an outside chance that they cut in May because if you look at it, they're cutting 3 times with a median of 2.6%, 2.5 to 2.6% inflation. There's an outside chance we'll be there by May. So I wouldn't preclude it if that's the threshold. But, the market's waiting to see it happen. I mean, unfortunately, they're not acting on our forecast.
But what's actually driving this, though? I mean, against the economic backdrop, there were a lot of people that looked at the Fed meeting last week and thought, okay, is this maybe a little too dovish? I know that's what the market wanted, but against that economic backdrop, why are we still talking about 3 to 4 cuts?
Well, you might call it yield differential preserving cuts.
Okay.
So, if everybody cuts by, 50 basis points over 3 months, the Fed is still the high yielder.
Right.
And the market's saying, what difference does it make if it's the Fed 5 1/4 and everybody else 3, or the Fed 4 3/4 and everybody else 2 1/2?
Okay, so this is more about the relative game for investors here. Then let's fold the yen into that conversation, because if there's any sort of relative relationship that's been out of whack over the last few years, it's been yen versus probably, I guess, the rest of the world.
Yeah, look, the Bank of Japan has been obsessed with the long yen, whether it's because of Japanese government debt, which will have a problem if the long yen moves up too fast, or because of the situation of Japanese regional banks. What they did at the meeting was kind of say, we're getting rid of YCC, the title, but everything we did under YCC we can pretty much do in the future if we decide that that's what we want to do. And I think the market was pretty dissatisfied with that. On the other hand, they do seem concerned about the yen weakening. And some of the comments that's coming out since then suggest that maybe they see a little bit more room for moving quicker than the market had anticipated. So that would help the yen.
They definitely have verbally been in the market. It just hasn't done anything to really help support the yen. And is the yen ever going to get some real steam to the upside, for example? Because no matter what, the rate differentials are going to be huge. Even if the BOJ hikes and the Fed cuts, for example, it's still going to be a fairly large differential.
Well, I think moving down by 25 basis points isn't going to do much. There's an old children's story where the punchline is soft ice cream is soft ice cream. 250 basis points of real yield is 250 basis points of real yield. It's very hard to resist. I think over time that should compress. And the question I keep asking myself is, all you're going to do is 10 or 20 basis points. Why bother? It's not as if anybody cared that you were kind of minus 10. For some rates. So it's quite possible we'll see a more aggressive BOJ.
Interesting. Also, I guess I find what's interesting, too, is that the repatriation thing we were all waiting for and sort of the unwind of the carry trade, is that going to happen? If, as you say, 10, 20 basis points hike, who cares?
Well, strangely enough, even though we're all talking about the U.S. equity market, the Japanese equity market has way outperformed, whether in common currency or local currency. Euro area equity market has outperformed. So, there is a question if the market decides that some capital should be going back because there's value there, and that would be a big help. So far, that hasn't been the decision. It's more focused, as we started by saying, who goes first, and so who do we hit first?
All right, Stephen, always great to talk to you. Stephen Englander, Global Head of G10 FX Research over at Standard Chartered Bank. And he makes a good point here. We talk about, what is it, like a 20+% rise in the Nikkei versus what are we up on the S&P, something like 9-10% on a year-to-date basis. And then to your point, too, about the yen, I was taking a look, I was on vacation when they had the big meeting, the big announcement. I was expecting to see some fireworks here.
Nope.
And then I came back, and what are we, like 151 right now on dollar yen?
Snoozer.
Yeah.
Total snoozer.
Yeah.
I mean, and also you could argue that if you have a stronger yen, that doesn't make equities that attractive over in Japan either. So do we really want, do investors there really want that stronger yen for that?
Yeah, good question here. All right, a lot more to talk about here on the big show. We're going to refocus right now on, well, an executive shakeup, one of the biggest aerospace companies in the world. We're going to talk to an analyst about why Boeing's CEO Dave Calhoun and his upcoming departure is a, quote, necessary one. That's next here on The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start with Foot Locker, an upgrade to outperform over at Evercore ISI. Meetings with executives actually highlighting some new ways that company is going to drive revenue, and that includes the launch of a loyalty program and a new digital app in North America. The analyst also says Nike's move to fully re-embrace the wholesale channel, that's going to be a net positive for Foot Locker. Those shares up about 7% on the day, a 6-day run, longest daily win streak in more than a year. Next up, let's take a look at McDonald's, getting cut to hold from buy. This over at Argus Research. The analyst not too fond right now of traffic at the fast food chain, saying customers right now are still opting to cook meals at home rather than dine out. Still, he calls McDonald's a good bet for long-term investors, primarily because of the franchising spread, those share buybacks, as well as that boost in the dividend. Nevertheless, McDonald's shares down 1.5% on the day. And finally, EV makers, Tesla, NIO, Rivian, all getting cut to neutral from buy. This over at Mizuho, with the analyst still constructive on the broader EV landscape, but says in the near term, demand and tightening liquidity are going to create too many challenges for the sector heading into 2025. And right now, it says Rivian has way too much inventory and not enough demand. Those shares moving lower by just about 2% here on the day. And those are some of our top calls. All right, we do want to stick with the industrial space, transportation space, if you will, and talk about one of the biggest stories of the day. That involves Boeing and the decision to get rid of at least 3 executives. CEO Dave Calhoun going to be stepping down at the end of the year. Meanwhile, 2 other executives going to be making the move out of the picture almost immediate. That includes Stanley Deal, who headed the Boeing's commercial airplane division. Joining us right now to help sort through this is Josh Sullivan, equity research analyst covering the aerospace sector over at Benchmark. He's got a buy rating on Boeing. Let's start off right now, Josh, here with the departures, and we say upcoming departures for at least one of these folks. Of these 3 executives here, do you think that's going to be enough? Is that the right decision, Josh? Clean house, get some new folks in there, and turn this around. You're happy?
It's the first step. The confluence of factors are obviously coming together here. This team was brought in to be a crisis manager themselves when 737 MAX, the initial crashes happened, and then COVID came after that. So, as far as Calhoun being a crisis manager through those, those were challenging environments, as they were for everybody, and we worked through those. However, it was really, ramping production back up. And obviously taking the eye off the ball on the safety factors, just, the P's and Q's of getting manufacturing right, which, can you totally blame that on Calhoun? No. The supply chain in itself was beginning to recover from COVID. You had a big changeover in the labor force. You had some of your most experienced, technical personnel across the manufacturing and supply chain retire during COVID and were replaced by a newer generation. And so there's a learning curve there. But at the end of the day, you've had a loss of confidence from airlines, from the FAA, multiple safety incidences. So as far as a new beginning, yes, this is a good start.
And but there's a culture issue here, Josh. And you talk about the decision to replace and the idea that these airline executives wanted a meeting with the board, sans David Calhoun. That says a lot. It raises the question, though, is who you put in there. It's easy to say, okay, Calhoun doesn't necessarily deserve all the blame. I mean, as CEO, you're going to get the blame. Does he deserve it? No. But he was also not really an airplane guy. He was not really a guy who was there to fix the culture. He was more about the numbers. He maybe did a good job with that for a certain period of time. But when it finally got to the stage where they needed to address these cultural issues, it really became clear he wasn't the guy. So who is?
Yeah, I think that's why it's an ongoing process. You've got to talk to the FAA. They still need to raise production or allowing Boeing to raise production on 737. So all of these stakeholders, the union is now making a discussion where they want a board seat. Airline customers, you referenced those meetings that were to take place this week. They probably need a hand in it as well. So I don't think that there's any one solution right now that you can put your finger on, other than to say that it's going to be an extensive process with all the stakeholders in mind. Because you've got to reinvigorate, as you point out, the culture of Boeing. Yeah. Boeing's a great American brain. They have arguably led the way for most of the last century. So how do we reinvigorate that? How do we, get confidence to our customers that our product's safe? How do we give confidence to our suppliers that they're important and that we're not going to press them on margins and that, safety is paramount? So there's a lot of discussion that needs to be had. And that's why, staying on to the end of the year is helpful in designing those discussions and bringing all the stakeholders to the table.
So, Josh, some names that I've heard is Pat Shanahan, who runs Spirit Aerosystems. I've heard Larry Culp. I've heard David Cody, former CEO of Honeywell. Of course, Larry Culp is CEO of GE, formerly of Danaher. Any of these guys make sense? Are you hearing that? Who are you hearing?
Yeah, no, all those names come up. Culp's obviously doing a good job at GE, so whether or not he's on the table. I think it's going to be an exhaustive process. You're not just bringing in a crisis manager. Yes, there is a crisis that needs to be managed, but you also really need to reinvigorate the brand and the excitement around Boeing. Part of the worry is well, how are you responding to Airbus's portfolio set? What is the technology? There's not a clear path right now, but how do you still invigorate that culture? So I think all of those names are on the table. A lot of people point to the merger with McDonnell Douglas, and how do you get back to that culture of innovation and focus on flight versus more of a financial approach. So I think those names are relevant, but I wouldn't say they're the only names out there. I think it's going to be a pretty exhaustive process. Look at who's in charge of the board right now with technology personality. So I think that it is going to be an exhaustive process. It's really going to have all the stakeholders involved, because you have to. You've got a lot of airline customers that are really upset with where the brand is going, and sort of bring them back into the fold and not open up yourself to competition. You want them part of the conversation.
Hey, Josh, thanks a lot. Super appreciate it. Josh Sullivan over at Benchmark. What's interesting, though, and Guy Johnson put it perfectly on radio today with me, he said he is now a lame duck CEO. He's a lame duck CEO at the end of the year at a time when you're going to try and bring Spirit Aerospace.
It was completely baffling to me that they're going to let him stick around to the end of the year. It is
to do
March 25th.
Yeah. All right. Anyway, coming up, Cleveland-Cliffs is going to receive a lot of money from the Biden administration energy investments. We'll talk to the CEO. This is Bloomberg.
All right, just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Yes, I am. Yes, I am. I'm typing. I'm not reading the prompter. What am I doing? All right. Let's take a look at energy companies. So shares of Cleveland-Cliffs are higher today. So this is one of many companies that the Biden administration awarded about $6 billion in grants to help cut emissions from metals and chemicals and other hard-to-decarbonize industries. Now, Cleveland-Cliffs was awarded $500 million to install equipment that would allow steel to be made using hydrogen, and an additional $75 million to electrify production of a specialized steel needed for electric transformers and other parts of electricity sector. This is all part of the push from the government to greenify. I'm making up the word, but greenification feels like a solid word. Joining us now to discuss is the CEO of Cleveland-Cliffs, Lourenco Goncalves. Lourenco, it's great to get your perspective on all of this. What was it like to get this money? And how quickly do you put this money to work?
Yeah, always a pleasure being with you, Alex, and with Romaine. Look, this money will be put to work very quickly, and we will execute on the project the same way we executed by ourselves with the direct reduction plant in Toledo, Ohio. We have been on the forefront on decarbonizing through the investment in big projects, difficult to to handle and difficult to execute, but we know what to do, and that's one of the reasons why the Biden administration awarded this co-investments to Cleveland-Cliffs.
Without the money from the Biden administration, could you make any of this possible, sort of move from coal and natural gas to hydrogen?
No, we could not. These are real infrastructure type of products. It takes policy, it takes resolve to make these investments, because these are multi-year, I would say multi-decade type of investments. So we cannot change the landscape just with a company changing the landscape, because we need the infrastructure to feed the project. We can't generate the feed of hydrogen by ourselves. So these things need to come on a more coordinated way, and the Department of Energy, Secretary Granholm, President Biden are doing the right things on that.
All right, so the money's there, and it looks like you're on board with this, Lourenco. I am curious about the competitive nature of this. Do you have any worries here that the net result of this, relative to your competitors outside the U.S., those not getting this money, does that help you or hurt you?
Look, at the end of the day, we are technologically ahead of our competitors outside of the United States. Let me give you an example. Japan talks a good game on technology. Japan doesn't have natural gas. We do. So that gave us a head start on the ability to use hydrogen. I've already tried the hydrogen in 2 blast furnaces. The one in Middletown, that's a small one, and the one in Indiana Harbor, that's the largest in the Western Hemisphere. So we are technologically ahead. Mm-hmm. We supply steels for the same automakers that they supply, and we can do anything we want with our workforce.
Can you do anything you want with the current business structure, or do you need expansion? Do you need to build this business beyond just what you have? And if so, how do you do that? Do you do that organically, or do you do that through acquisition?
We have done organically so far. That's the first time that we have the help with a co-investment from the government, and acquisitions help because we can, through acquisitions, we can use a bigger footprint, and dilution of fixed costs in our business is key. So it's a combination of both, Roland.
Now, you mentioned that you're able to reduce costs quite a lot by using cheap natural gas. If we allow natural gas to be exported in the way that we have, and there is no ban on new export facilities, does that change for you? Does it raise the price for you?
Well, the reduction in costs by doing what we're doing comes from replacing one process, that's the coke oven blast furnace route, with another route that is direct reduction and electric melting furnaces. So we are comparing 2 different things. As far as exporting natural gas, I think the United States should continue to export natural gas as long as natural gas is available and as long as we are benefiting from that. So, but we don't have a say on that. We're users of natural gas. We don't produce natural gas.
No, but that's what I'm saying. That's why it's good to get your view, because you use it. And if you're for it, then that's something to definitely think about. Talking to sort of the growth profile that Romain was just speaking about, if the Nippon Steel U.S. Steel deal doesn't go through, are you firm that you won't bid for more than $30 a share? Will you reconsider this?
That's a great question, Alex. Before I came to sit here to speak with you and Romain, I made a calculation based on the current stock price. If my offer had been accepted, let me refresh my offer. My offer was 1.444 shares of Cliffs per share of U.S. Steel plus $27. You make the calculation with $21.46, and you're going to see that my offer would be $58 per share. Nippon Steel offered $55. I had support from the USW. Nippon Steel didn't have support from the USW. I discussed with the U.S. government prior to making the offer to make sure that I had a path to clear antitrust, and U.S. Steel decided not to listen and go with Nippon Steel. Now, the President of the United States has spoken. He said this deal will deserve serious scrutiny, and the ownership needs to stay with the United States. Yeah. So the table has been set. The ship has already hit the Titanic has already hit the iceberg, and now it's a matter of time, a matter of little time before the ship sinks.
That's a nice premium, and I can understand why you would be upset that a company would not even consider it. But do you have the financing laid out for this? Because that seemed to be the concern when this was first made public.
Oh yeah, we had a fully committed offer. We had support from Wells Fargo, JPMorgan, UBS, and Truist. It was fully financed. Yeah. We had everything in place. But, U.S. Steel decided that trying to sell to Nippon Steel was a better outcome. So they were...
Would you be interested in remaking another offer, even if it's at the same price?
Look, I'm not going to negotiate on live television.
You're welcome to.
Yeah, no, but I'm not going to do it. I'm sorry.
Yeah.
But right. we will be at the other side after the deal is unraveled. Yeah. And we'll see what I can do. I'm very concerned about the workforce, and I feel bad for the fact that these people are being treated like if they don't exist. Okay. So they unionize the workforce, the USW workers over there. I'm going to be able to do that as fast as I can. I'm just waiting for the final move from President Biden, and I hope it's.
Well, there's a shareholder meeting also in about 2.5 weeks' time, Lourenco.
Yeah, but that doesn't change anything. I fully expect that the shareholders will approve the deal, and so what? Because, like I said before, after the ship hits the iceberg, you can vote if the ship will sink or not. The ship will sink. If I had an offer of 55 in front of me, I would vote for the offer. So there's no surprise on that. We all know that the shareholders will approve the offer. But don't forget, my offer, if you still had picked my offer, as of right now, at 21.48 would be north of 58. So they did not pick the highest bidder. They picked the one that they felt that would be successful in a transaction, and bad mistake.
Lourenco, we really appreciate it. When you do want to come on and make the other offer or talk about it, please come back to us. Lourenco Goncalves, we appreciate it, Cleveland Cliffs CEO. But I found the combination of all of this quite interesting. Mm-hmm. You need the scale if you're going to decarbonize. It's very difficult to decarbonize industry and compete with a flood of material from China. You need that scale in addition to government money. Well,
that's what I'm concerned about, too. I mean, it's easy. I mean, it's admirable that we're doing this as a country, but at some point, whoever's in power over the next few years is going to have to really assess our tariff structure and whether our companies are going to be made more vulnerable by this.
And it depends on what the product winds up being. Like, if you get cheap natural gas, maybe the product price is the same or cheaper, right? But if hydrogen is expensive, you have to charge more for the products, and who's going to pay for it? In which case, you have to get that hydrogen price down enough to make it competitive. I don't know how you do that. All right, coming up. Are you a gamer, by the way?
I am.
He is a gamer. I knew it. Grand Theft Auto fans might have to wait a little bit longer to play the newest version. You got shares of its developer Take-Two Interactive feeling the punch in today's Stock of the Hour. We will drill down worst performing stock in the S&P. This is the close on Bloomberg.
All right, time now for our Stock of the Hour. Biggest decliner in the S&P, Take-Two Interactive. Shares falling after reports that its Rockstar Games unit may not be able to release the highly anticipated Grand Theft Auto 6 by spring of 2025. Abigail Doolittle joining us for a little bit more on this. And I don't know if you remember, Abigail, back in December when they finally, after months of delay, finally said, look, we're working on this. It'll be out by 2025. Shares plunged in because nobody believed it was going to happen. And now we're learning this may be pushed out to 2026.
It sounds like you have some passionate interest in this, perhaps for your own gaming interests. I am not a gamer, so it's interesting to always see the amount of buzz that is created over that. But that's exactly right. There was that plunge at that time. And this has been the major overhang on the stock, that this game would not come out on time. So we have this report today coming out, where it actually came out on Friday, that the game may not come out when it's expected to in the 2025 window. Right now, the expectation is the release for spring. Now, the reason this matters is some analysts think it could sell 40 to 50 million copies in its first year. Until it comes out, apparently the NBA and the WWE games, which you may know more about and than me, and maybe I don't know about you, Alex, if you're a gamer or not. But the expectation is that Rockstar will deliver this by the spring of 2025. If it doesn't, it means a massive hole in revenues, because right now revenues next year are expected to grow 34%, up to $7.1 billion from $5.3 billion on the success of that game. So that's basically $2 billion in the mix.
I didn't know that sometimes these cost more than like a movie to make. That kind of blew me away a little bit. And I have to wonder, is it bringing down other gamers too? Because this would be a big deal all around?
It's more of an idiosyncratic story. It's interesting that you're saying that, though, Alex, because I was talking to one of our colleagues about this, because, again, I'm not a gamer, but he was talking about how involved it is. I'm not surprised to hear, because if you can go into all these different little worlds and play it this way. But, yes, we basically have the other stocks mixed. But in related news, to some degree, it's interesting. These games are tracked on app selling basis per week. Ubisoft is the one that had the worst week. Take-Two, okay. But again, in terms of this being the major risk for the stock was up 30% into today from Friday. This is, causing it to go. In fact, it's back below its 200-day moving average, so sellers are in.
Alex, I need to go back, look at all the other GTA releases, and ask yourself which one of these was actually released on time. It's a trick question.
Yeah. Oh, no. I used to be that reporter who would talk to the people in line who waited out overnight. I used to be that person. Yeah. So I'm definitely aware of the hardcore guys. All right, Abigail, thanks a lot. Really appreciate it. Coming up, we're going to count you down to the closing bell with Emily Roland over at John Hancock. This is Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Alex Steele. 10 minutes until the bells, Alex, and I guess a bit of a breather coming off of that rally that we saw last week.
A little bit, but individually, some things are really moving. Energy, for one. S&P Energy is the best performing sector in the S&P.
Right.
You also wind up having two other ones, which is Supermicro. You had an upgrade over at JPMorgan, initiating with a recommendation of overweight, calling it, quote, forefront of the AI revolution.
Yeah.
Feel like they might have missed a little bit of a move, but nonetheless. And Constellation Energy, which is a power company, but they're kind of linked in that you need power to provide the data centers to use AI. So they're all kind of linked to see what's actually rallying today. Absolutely. All right. Well, I mean, some stocks are moving, and you do have some bright spots out there, as Alex was just talking about, despite the rally taking a bit of a breather. We did have a chance to catch up with JPMorgan Asset Management's David Lebovitz, who talked about what it would take for him to sell into this market.
To me, would be some sort of more definitive deterioration in the labor market. And, labor markets have been very well behaved. Claims have stayed low. You've seen them edge up ever so slightly. Job openings are beginning to come down. The unemployment rate went up by 20 basis points, although I wouldn't turn a mouse hole into a molehill. I think that you would want to see payroll growth slow significantly, the unemployment rate begin to rise, and some of the survey data really begin to roll over. Because it's interesting, right? Employment in the PMI sub-indices, just as an example, was relatively resilient even during periods where people were asking some questions about broad-based labor market health. And so I don't think you want to hang your hat on any single data point.
All right, David Lebovitz joined us to help kick us off to the close just about an hour ago. Taking us to those closing bells now, Emily Roland, co-chief investment strategist over at John Hancock Investment Management. And Emily, I mean, you've seen the economic data. We've just got done with an earnings season here. I mean, all of the signs that we've gotten out of those points seem to suggest that, there is something here to support the moves that we've seen in the equity market. You buy that?
Yeah, absolutely, Romaine. We've seen a couple of things happen. You mentioned earnings season. The expectation was for negative earnings growth in Q4, and we actually came in positive. We saw some nice beats across sectors like technology. Earnings growth was okay. It sort of reminded me of my son's grades. He's in 8th grade. They're not that great, but they're good enough that he's still, on the football team. But they were fine. And we're seeing the same thing from a macroeconomic standpoint. Last week, for example, we saw the leading economic indicators come in positive on a month-over-month basis for the first time in about 2 years. The PMI data, David mentioned survey data, we're seeing that perking up in the United States as well. So we are seeing this modest reacceleration in economic growth, in inflation. China stimulus is helping with that. So, everything seems to be pretty awesome, but that's also priced into the market.
Absolutely. But some of the concern for those folks who maybe are a little bit more pessimistic out there, Emily, they're looking at current conditions, meaning earnings and economic data, and then looking forward and saying, look, why haven't we seen earnings revisions go up for the next year or the next year out after that? If this is that much euphoria and that much optimism in the market, when do we actually start to see folks on Wall Street start to adjust their targets?
Yeah, I mean, earnings estimates right now are being penciled in for about 11% year-over-year growth for 2024. So I'd say, that's a pretty high bar. And of course, that comes on top of the S&P 500 trading at a 21 times PE ratio. So there's a lot of this, I think, positive sentiment that's already baked into the markets. Listen, this is what usually happens during this point in the cycle. We have now a much higher cost of capital than we had a couple of years ago, and the Fed is keeping rates elevated at the same time that revenue growth, while not horrible, is certainly normalizing and coming down from those explosive levels that we saw when we pumped $5 trillion of stimulus into the economy to fight the pandemic. So we have, usually what happens is company margins are shrinking, and they deal with that by cutting costs. And the biggest cost that most companies have, of course, is people. So the last shoe to drop in every economic cycle is that the unemployment rate shoots up, but we're just not seeing that happen. We're seeing some cracks in the labor market, but to David's point, we're just not seeing it show up in the hard data yet.
So, Emily, how do you hedge something that may or may not happen?
It's a great question. As investors right now, this is a really tricky period because we're in this sort of never-ending late cycle environment, and there's an increasing narrative that we may have the no landing scenario, which would be historic, meaning that the Fed just raised interest rates to the greatest extent in the shortest amount of time that we've seen in decades, but we're not having a recession or a contraction in economic activity. If we are seeing a real sustained reacceleration, that's TBD. We still think the data are sort of chopping around in sideways fashion. That would lead you to want to own more equities on the value side. There's a catch-up opportunity there as those have lagged growth. They're on sale. Sectors like industrials and energy could see a real, really would deserve a look in portfolios if we are seeing a reacceleration in the data.
Yeah, and that's what we've seen this last month. Energy, materials, industrials, all leading the way higher on the S&P. Do you think a rotation into those sectors will be enough to offset, say, tech not going anywhere anymore?
Yeah, it certainly could be. And what we've been doing is we've been balancing an overweight to mega cap tech because we like quality. So we want companies with great balance sheets, lots of cash, great return on equity. Tech is really the poster child for that, mega cap tech, but we've cited the fact that they're clearly overbought. I think it's tough to argue they're not. S&P 500 growth index is trading at about a 45% premium to its 20-year average. So we've been advocating balancing that with parts of the value complex. Mid-cap equities are trading at a steepest discount to their large cap counterparts since the late 1990s. Areas like industrials may benefit because of their operating leverage in a period if inflation does reaccelerate. And of course, energy being the key example of an area that could benefit if we do see increased demand for commodities. And frankly, China is starting to show that. So we're seeing some opportunities across areas that have really been beaten down as we pair that with that classic quality factor.
All right, Emily, great stuff. Always great to talk to you. Emily Roland, Co-Chief Investment Strategist at John Hancock Investment Management, helping us count down to the close with just about 3 minutes to go. And it's interesting here, our final comments here, talking about what we're seeing in small caps and mid caps. And we've seen these head fakes before, where everyone finally starts to embrace value, starts to embrace small caps, and then it kind of blows up in their face. I should point out, I mean, the S&P 400 mid caps at a record high, kind of hit that, I think, a couple earlier this month, and has held that. Russell still, as I was looking at it today, still has like another 15% or so to go before the Russell 2000 gets back to its record high, but it appears like it's on its way.
But it's at like a 2-year high, so there is that. S&P Equal-Weighted Index last week also hit a record high. Just a matter, I think, of sustainability, and also does the headline level. Can the headline level hold up despite the fact that maybe tech isn't going to be catapulted higher anymore?
All right. Well, the only major index in the green on the day is the Russell 2000, up about 0.1%, with the rest of the market in the red as we move closer to the closing bells here on this Monday afternoon. A full breakdown of all the market moves as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell, here to help take us beyond the bell. It's a global simulcast, joined by Scarlett Fu in Studio 2, Carol Masser and Tim Stenovic in the radio booth or fishbowl, whatever they're calling it these days. Welcome to our audiences across all of our Bloomberg platforms as we sort of break down the market moves on the day. Nice to see you, Carol and Tim.
Nice to see you. Welcome back.
Yeah,
welcome back.
You.
We missed you.
Absolutely. I missed you too.
Having said that, it's interesting to see. Here we are. It feels like markets are a little bit tired, the equity markets, but we're actually seeing some selling into the close here. I'm just kind of watching my Bloomberg, which is not, I don't feel like a trade that we have seen in a little bit of a time. So again, a lot of economic news this week, so we'll see whether or not that changes it. It's also, I feel like, holiday shortened week.
Holiday shortened week, yeah. You know what never goes on vacation is Bitcoin. So we might be seeing some selling into the close for U.S. equities, but Bitcoin higher by 7.4% today. It's the first time the token has been above $70,000 in more than a week, up to $71,000 as we speak.
And it's taking all those Bitcoin-related, crypto-related companies up with it. Whoever's doing gainers today has plenty to choose from. If they're going to look at Bitcoin names.
I actually was changing 2 minutes ago.
But this is what I find so interesting. I was talking about this with Romaine just a second ago, is that, yep, Supermicro, best performing stock in the S&P, but the third is Constellation Energy, and they provide energy for the companies like a Supermicro to do the AI and all the data center stuff. So it's like one story that seems to have like octopus arms at this point.
All right, as we get the closing bells here in New York, a mixed bag, but of course, we have to point out this is coming off of that record run that we saw last week, a record run that we've seen all year long. So a bit of a breather, a bit of a give back, but still holding some of the highest levels we've seen in our lifetimes. The Dow Jones Industrial average above 39,000, though it is below that on the day, down by about 160 points or 0.4% lower. The S&P down about 16 points or 0.3%, while the Nasdaq is going to close out the day lower by about 44 points or 0.3% as well. And I was just telling you this, the Russell 2000 holding in the green here on the day, oscillating between gains and losses, but finishing out the day higher by 2 points or about 0.1%.
All right, good to know. So the Russell in the green. Going back to the S&P 500, so those big cap names. Scarlett, we've got 187 names to the upside, so gaining in the Monday trade, but more to the downside, 311 to be exact, 5 unchanged. So really kind of more of a risk-off trade in today's session.
Yeah, especially with the S&P and the other indexes swooning in the final minutes of trading today. Look at the IMAP, plenty of red there. You've got industrials, tech, and real estate investment trusts all down, but none of them losing more than 0.7%. On the flip side, those that bucked the decline, energy, and Alex, there's your Constellation Energy. It's leading the way up for the energy index, and utilities and materials.
All right, so let's get to some of the gainers. Don't judge me in terms of who I chose. Boeing was up 3.9% at its highs today, finishing the day with about a 1.4% gain. You guys know the story. We all know the story. We've been saying it. It was a big one when it broke before the market opened this morning. The company making some major executive changes, senior executive changes, among them CEO Dave Calhoun announcing that he will step down at the end of the year, but also changes in terms of the board and who is really running the big part of the business. But nonetheless, investors happy to see some kind of change at that company, at least starting amid all of its problems and concerns over the 737 series. All right, Micron, it is the number 2 gainer in the S&P 500, number 1 gainer in the NASDAQ 100, finishing with a gain of more than 6% today. It is its 7th straight positive session, so we're talking about maybe around, 30% over that span. I didn't quick do the math, but close to it. But nonetheless, we're talking about a record run here on this company. And a lot of it has to do with the company's results from last week. It had a strong sales forecast. We broke it down. We talked about it, buoyed by demand for AI hardware. So that play continues to be on the minds of investors and pushing Micron higher. Lucid Group.
And not just hardware, though. It's really the memory stuff. I was actually surprised I was off, but I saw that move last week. And that's really about this idea that once you run all that data using whatever chips you got from NVIDIA, you got to store all that data somewhere. And well, that's where Micron comes in, right?
Yeah, exactly. The hardware side of it. Yeah, exactly. So really significant. So that one's a standout. I just want to mention quickly, Lucid Group, it's had its high, was up almost 21%, finishing the day with about a 5.5% gain, getting a $1 billion cash injection from its biggest investor. So we're talking about an affiliate of Saudi Arabia's public investment fund. And finally, I have to mention Reddit, which was up 30% here. It's third day since its IPO. So it's up about 75% in those 3 days. But again, another another 30% move to the upside. So investors continuing to like that name, or just, I don't know, like that it's IPO'd recently.
Well, speaking of tech, let's talk about mega cap tech, because shares of those companies pulling the S&P 500 lower today. Among them, Microsoft, Apple, and Meta Platforms. Apple finishing the day down 0.8%. This all because the European Commission said Monday that Apple and Google's App Store rules will be targeted in the first probes under the Digital Markets Act. Also, how Google's search results might unfairly preference its own services, and how Apple may make it harder for users to choose alternatives in its Safari browser. We should note an Apple spokesperson said the company is confident it does comply with the DMA. You'll recall just last week that the Justice Department and 16 attorneys general sued Apple, accusing the company of violating antitrust laws by blocking rivals from accessing hardware and software features on its devices. Also, let's take a look at shares of United Airlines, which fell after Bloomberg News reported that U.S. aviation authorities are considering drastic measures to curb growth at the company. Shares down 3.4% today. This including preventing the carrier from adding new routes following a series of safety incidents. The FAA has discussed temporary actions that it may take with the airline's leadership in recent days. That's according to people with knowledge of the matter. And also shares of Take-Two Interactive. They fell as much as 7% on the day today, closed down 4% after Kotaku reported that the production of Grand Theft Auto had started to fall behind and the video game could miss its 2025 release window. The video game website cited unnamed sources there. Shares down more than 4% today. And I do want to talk real briefly about shares of Fisker, the EV company that we talked about last week. They fell 28% today. This after the company said in a regulatory filing that talks with a major automaker about an investment were terminated without a deal, which means the company needs to renegotiate terms for recent financing, or it could face the possibility of filing for bankruptcy protection. Shares were halted just before 10 o'clock this morning.
Yeah.
News pending, and we don't have that news quite yet.
Do you think that has any correlation with the
I think it does.
Okay.
Yeah, I think it does. I don't know for certain yet, Romaine. We'll have to wait and see, but I think they could be related.
Yeah, that's pretty brutal for that company. So guys, just quick check in here on the bond market. So yeah, you're seeing a little bit of heaviness here as bonds are on offer, yields move a little bit higher, but we had that 2-year auction today, which was actually quite successful. You saw a strong bid to cover, the yield was a little lower. Tomorrow we get 5 years, $67 billion, and then Wednesday we get $43 billion in the 7 years. So sort of healthily digesting the sales here so far of this week, guys.
You know, so interesting. I was just looking at the Fisker share price. What was it, 9 cents a share? So I'm thinking this gets us to our next story, that you could buy, what, 900,000?
Are you going to do math right now?
Well, I'm thinking of cocoa, right? It's gotten really, really expensive.
Don't make me do math. That's all I ask.
So it's getting close to $10,000. Was up more than $700 today, up 50% this month alone. So how many shares of Fisker could you buy? I know. Come on, Romaine, you're like quick on this math. Is it 900,000 shares of Fisker?
That feels hard. Why are you doing this to us?
I don't know. So sorry.
This is literally a bad dream.
All right. So anyway, cocoa is more expensive than copper. It topped $9,000. As I said, it's up about about 50% this month alone. It's more than doubled already this year. So guys, all of those Easter bunnies and eggs, they're going to cost a lot. And it has to do with bad weather, crop disease, and West African growers where most of the world's cocoa is grown.
Yeah, you kind of need like perfect conditions, right? Like you can't have it too dry, you can't have it too windy because it knocks down the cocoa trees. It needs to be in the rainforest area. So like it's only a select area that you can actually grow all of this stuff. And there's underinvestment, regardless of the weather, guys. In a drought, it's underinvested, and that might be prolonged higher prices.
Okay, so speaking of those higher prices, Easter eggs are already getting more expensive due to last year's price jump. Some manufacturers are even making the size of bars smaller.
Shrinkflation.
What?
Or they're using other ingredients to soften the blow
Lots
here.
of marshmallows in those chocolate.
Yeah.
You know, the thing is, the higher chocolate prices in stores right now reflect increases in cocoa from 2023. So next year is when those chocolate Easter eggs are going to get really pricey.
Yeah, I mean, we're already looking the prices have doubled. But I think when those new contracts come in, remember we had that strike. It was like a couple years ago when we had cocoa prices go up. And then it got to the point where a lot of folks didn't want to honor the old contracts because they saw the new money. And I wonder if we're in for that again. I think the season kind of starts in May, or that selling season in May.
Because it's hard to hedge these things. It's a little, Oil is different, but it's hard to hedge this, especially if you're a farmer. So that kind of adds into it. Wait, I'm going back. So wait, I'm making chocolate with more marshmallows? Is that what I'm doing?
No. You're just going to take out some chocolate, add some marshmallows, just add other cheaper ingredients.
No.
Ew.
Blasphemy.
I'm not doing it.
Blasphemy.
I judge that.
I judge that too. All right. That's a wrap. Our cross-platform coverage, we end on cocoa. Cocoa? How do you say it?
Cocoa.
Just own it.
All right. Cocoa. No, what do you? All right. It's a wrap. Sorry, it's again a Monday brain. All right, that'll do it for our cross-platform coverage. Radio, TV, YouTube, Bloomberg Originals. We will see you again tomorrow.
And our coverage continues right here on Bloomberg Television. Not all chip stocks did well today. Shares of Intel closing lower. This one reports that China is going to phase out the use of their chips in government computers. We're going to have more on that after the break. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu with Romaine Bosick. The stock market rally has stalled here. Blame it on a lack of catalysts. Right now, it's a waiting game before the week's most important data point, which will be PCE on Friday when the markets close. Jay Powell also due to speak on Friday as well. So you have the S&P 500 losing 0.3% on the day, a little bit of a swoon into the close. Yields moving higher. We had a 2-year auction today that was kind of meh, not great, not terrible. We have a 5-year and a 7-year auction later on this week. Notable that today's move higher in the 10-year yield leaves it just above the 50-day moving average and the 200-day moving average as well. NYMEX crude up by 1.5%. A bullish note from Goldman Sachs on commodities on worsening geopolitical unrest following the attacks in Russia, giving some support to crude oil prices. And Bitcoin continues to zoom higher, resuming its rally and now approaching $71,000. Let's get you to some individual movers. Take-Two losing 4% on the day on a report that Grand Theft Auto 6 is starting to fall behind, and the video game could miss its 2025 release date and may not be available until 2026. Again, this is on reports. United Airlines losing about 3.5%. Bloomberg reporting that the FAA may temporarily halt growth at United following a series of safety incidents. That includes perhaps preventing United from adding new routes, especially before the busy summer travel season. Disney, one of the best performers in the Dow Industrials, gaining 3% on the day. Barclays upgrading it to an overweight, saying a narrative reset since the first quarter results should be followed by positive estimate revisions. Later on this hour, we're going to talk a little bit about the proxy battle that is heating up as Disney shareholders get ready to attend the shareholder meeting on April 3rd. And Micron up 6%, record high, seventh day of gains here. It's added almost 30% in that period as investors basically re-rate the stock. Micron, of course, gave a strong sales forecast last week thanks to demand for all those AI hardware.
All right. Well, as investors start to re-rate Micron stock higher, they're also re-rating, some of its competitors lower. Shares of Intel and AMD closed down on the day. This after a report that China has adopted guidance to limit the use of U.S.-made microprocessors and servers in government computers. For more on this, we're joined right now by Ian King, who covers this space for us here at Bloomberg. And Ian, what's behind this move by China? Is there something substantive, or is this just kind of that tit for tat that's been going on with the U.S. and China for the last few years?
I mean, it's certainly substantive in terms of what it might mean for these companies and their access to the largest market for their technology. But you're right to characterize it as the kind of tit for tat. This is China, as they did with Apple, as they did with Micron that you just mentioned, saying, hey, America, Washington, if you're going to pick on our companies, you need to understand just how important we are as a marketplace for your companies.
So, Ian, if Intel and AMD are seen as losers here, does China have viable alternatives to these companies, either homegrown or foreign alternatives?
Yeah, foreign alternatives. Nobody else makes x86 PC processors. There are some attempts out there to make processors based on ARM technology, but they're kind of nascent so far. A short while ago, we did a write-up of a note and some research on Chinese companies that might be a substitute. There's a company called Hygon Technologies, and then, of course, there's Huawei. And they're really trying to get into this processor market, but right now they're not considered to be serious threats either in volume or in terms of the technology that they can offer.
All right, Ian King, who covers this for us at Bloomberg, and we should point out Intel gets about almost something like 25% of its sales from China. AMD a little bit less than that, but still significant. And when we talk about this AI story, it is certainly a geopolitical story, but it's also a story of cybersecurity. And as the competition between the U.S. and China heats up, a lot more investment is probably going to be needed in that cybersecurity space. So who better to talk to than the CEO of CyberArk, Matt Cohen, joining us right now here on the big program. And Matt, I do want to start there, particularly with this fighting that we've seen between the two biggest economies in the world, and sort of what this space is going to look like. Because this isn't just about that tit for tat. Whatever happens, whether Intel can still do business in China or not, there's going to be a need for both companies and governments to protect their data and protect themselves in a way that is much more materially different now that AI is a viable technology.
Yeah, and thanks for having me, Romain. And I think when we think about AI, it's really changing the landscape of how we secure critical infrastructure, organizations, governments around the world. You know, the very basic premise of AI is it brings advanced hacking capabilities to the masses, you know, and these organizations or governments around the world, nation states that have relied on hacking as a key element in their attack strategies are now able to be much more effective, even at basic attacks into our critical infrastructure and into our enterprises. And so it's a scary proposition, and one that we have to take real seriously ourselves as we build up our defensive capabilities to be able to protect our entities.
But how do you do that in an AI world? I mean, prior to where we are today, Matt, a lot of these systems are sort of closed off, but the very nature of artificial intelligence and the data collection, there's a certain sharing that needs to occur. There are people you have to let into your network to contribute. How do you know that those people are A, who they say they are, and that they're supposed to be there?
I mean, I think this is really where the juxtaposition of AI and what we do, identity security, come together, which is to try to understand the different identities, either human or non-human, that exist within the enterprise, and to make sure that for each one of those identities, we can apply the right level of controls. We call that intelligent privilege controls, that can make sure that we isolate the sessions that those identities have started, make sure we understand what each identity is trying to do, and by virtue of securing each individual identity, we can create a broader footprint of security for the enterprise. And in this AI landscape, we need to be able to apply new measures to that basic identity security posture.
I'm just curious about the state of cybersecurity right now, because you're only as safe as your weakest link. And we know that a lot of large companies are spending on cybersecurity to repel whatever attacks, but their vendors, who are often smaller companies, may not be. Which industries are best prepared up and down the supply chain? Which industries are less prepared?
I think all industries are under attack. We see that in the recent breaches within the hospitality world. We see it within critical infrastructure. We also see it in healthcare with some of the most recent attacks. So every industry is actually equally susceptible. And what we have to do is what you just described, is help bring up all enterprises, all entities with easy to access cybersecurity tools that they can apply rapidly in this threat environment. And for us, it starts with this idea of let's make sure that every identity, human and non-human, has the right level of privilege controls to be secure. We can do that more effectively and fast ourselves in the age of AI. We can use AI to make our tools easier to deploy. We can use AI to be able to leverage data to know when to shut down sessions or when to actually assume a breach posture. So we, as defensive entities, can actually use AI to help any company in any industry or vertical actually prepare for what's coming.
Very quickly, Matt, what's the most common cyber attack in 2024, and what's the one that worries you the most?
Yeah, I think we see for sure ransomware continuing to be a real threat for enterprises out there. We see 7 or 8 out of every 10 companies we talk to have been breached in the last year. And so ransomware itself is still the largest threat. One of the ones that worries me the most is actually post-authentication browser takeover. So people wait for actually people to substantiate sessions, to do their multi-factor authentication, to be actually then let into their critical infrastructure data systems, and then the hackers take over the session. And that means we need an entirely new approach to how we actually enable browsing and session management within the enterprise.
All right, Matt, going to have to leave it there. Really appreciate you taking time for us. Matt Cohen, he's the CEO over at CyberArk. And we're going to continue this conversation after the break. A big focus on AI with Henrique Dubugras, co-founder and co-CEO of Brex. You've heard of it. It's an AI-powered platform offering big companies and startups financial services. That's next on The Close on Bloomberg. All right, more and more companies are looking for ways to innovate, optimize their finances, and that's where Brex comes in. You know the company. It was a startup really known for its corporate credit cards, moving into the software space, and just last year, launching an artificial intelligence project really helping, designed to help CFOs sort of manage and track corporate budgets, policy, and spending. Pleased to say that the co-founder and co-CEO of Brex, Henrique Dubugras, joining us right now to talk a little bit more about this. And Henrique, let's get right to it. What's been the uptake so far of this new AI product? How many people are using it?
Thank you so much for having me. And you know, the majority of our customers are actually already using our new AI product. So we launched last year our AI assistant, which allows every employee in the company to have access to an AI personal assistant that does your expenses for you. So, you know, we had millions of expenses be done automatically, and, you know, hundreds of thousands of employees around the world have this benefit.
How do you make sure, if you're using AI to sort of track spending, track maybe potential fraud, the type of spending that maybe shouldn't be done, how do you make sure that that AI model is reliable, that basically you're not calling somebody out for something that maybe they didn't do?
Absolutely. So the first version of what we're doing is we're just calling out and just flagging for people, right? So your manager is kind of expected to review your expenses. You did something, someone has to approve it. Imagine now that we're doing those approvals or doing that reviews on behalf of the manager, but the manager still has to kind of like, you know, check it out and rubber stamp it, right? Because in the end, it's his name. But we can tell you with a lot of certainty that we already catch way more stuff than the managers will normally do, because managers have a job and they're busy actually executing on behalf of the company, while, you know, our AI, their only job is to catch fake transactions or, you know, things that are out of policy.
Thank you for explaining that. I want to pivot to your business overall, because we know that the collapse of Silicon Valley Bank worked in your favor. Brex ended up opening some 4,000 new customer accounts afterwards. 1 year later, Henrique, do you still see any signs of instability in this smaller regional bank space? How nervous or not are those banks' business customers?
I would say that what we've seen is a durable change in customer behavior, where customers used to have only one account in which they would have all their payments and payroll and everything go to. And now we see customers having multiple accounts. They use Brex, for example, to manage their business day to day, where they run their payroll, they pay their bills, they invest some of their money, but they still have a lot of their cash spread out across, let's say, the big banks like JPMorgan or Citi.
So that idea of a one-stop shop is gone now. Everyone wants to diversify to kind of stay safe. That's really interesting. I know that right now you're focused on free cash flow. You've cut 20% of staff recently in January, and you've outlined a plan to be well above cash flow positive with the cash you currently have. What's your timeline, Henrique, for turning profitable?
Yeah, we want to be profitable by the end of 2025, and, you know, we can definitely get there with the cash that we have.
Got it. In terms of these staff cuts that you did make in January, I know that you had made cuts in 2022 and 2020 before then. What went wrong earlier this year, and how are you course correcting?
I guess like every technology company over in 2021, we probably hired above what we should. And, you know, that's a mistake that Pedro and I as co-CEOs, we personally own. And we had to make adjustments because of that. And I think that, you know, in addition to that, I would say that now with the markets where they are and, you know, with the timeline to the IPO, obviously getting to profitability is a much bigger focus for us.
You still have plans to try to make that IPO happen anytime soon?
Well, not before we're profitable, at least. So.
All right, fair enough. Henrique, thank you for taking time for us. Henrique Dubugras there. He's the co-founder and co-CEO over at Brex. All right, a lot more coming up here on the show. When we return, we're actually going to take a look back at history, a major milestone actually for the Concorde jet, and some new efforts today to revive supersonic air travel. And we're going to leave you with a question before we go to break. The makers of the Concorde, Scarlett, had anticipated selling as many as 500 of these jets, but how many were actually built?
I'm guessing a fraction of that, maybe a third of that.
All right.
That might be generous.
All right. Well, it might be the answer when we come back. This is The Close on Bloomberg. All right. It was on this day 54 years ago, a prototype of the Concorde airliner sped through the skies at about 1,300 miles per hour. That broke the sound barrier. A Mach 1 milestone that meant supersonic passenger travel was indeed viable. The allure for passengers was clear. You fly from London to New York in less than 3 hours, around 2/3 shorter than the transatlantic flights of the day. But convenience often comes with cost. A one-way ticket would set you back as much as $10,000 in inflation-adjusted currency, and the plane, as sleek as it looked, it was a gas guzzler. It needed as much as 7 times the amount of fuel per passenger mile relative to modern jetliners. Now, the official unveiling of the Concorde at the Paris Air Show back in 1973 was expected to generate at least 200 orders. Only about 100 were placed, with most of those canceled after the Yom Kippur War spurred OPEC oil embargoes that led to unprecedented fuel costs. You combine that with the noise restrictions on supersonic travel over land, and the viability of the Concorde was now not really a viable option at all for almost all airline routes. And that brings us to my question of the day. While the makers of the Concorde did anticipate selling as many as 500 of the jets, all told, just 20 were ever built. And only 14 of those 20s were ever actually used for regular commercial service. And that was just by 2 airlines, British Airways and Air France. And they were the flagship carriers for the 2 countries that funded the project. Now, a fatal crash in the summer of 2000 was the final blow, and by the end of 2003, the only way to sit on the Concorde was at a museum, giving the Concorde the dubious distinction of being one of the biggest achievements in aviation history, as well as one of the biggest flops. But there are renewed efforts out there to revive supersonic travel. Just this month, Boom Technology, founded by a pilot and former Amazon software engineer, said it's adamant that it can develop a new generation of high-speed jets. You're looking at the latest test flight there. But it's going to be a tough road. A startup backed by billionaire Robert Bass abandoned plans for its own supersonic business jet in 2021, largely because of the lack of funding. Environmental and noise limit standards have only gotten stricter since the 1970s, and Boom Technology has said it will use sustainable aircraft fuel. Yeah, that's admirable, but it's also a lot more expensive and scarcer. And this doesn't even address the upfront capital expenditures needed. The original British-French Concorde project cost the modern-day equivalent of about $8 billion. Still, the allure of supersonic travel is a grand idea that won't go away. The appeal is certainly there, but the economics of it still needs to catch up.
Yeah, the idea of sustainable aircraft fuel, they would need so much of it. Where are you going to get that for now? It's an open question. Really, really great story there, Romain. Well, another story that we're keeping an eye on is the fact that just a little over a week until Disney's proxy battle with Nelson Peltz, the activist investor, finally comes to an end. Shareholders are scheduled to vote on April 3rd. We know Nelson Peltz's Trian Fund Management, which owns more than $3.5 billion in Disney shares, is seeking 2 board seats, as well as other changes to operations. Here with more now is Bloomberg's Crystal C. Crystal, you and I were just talking about how when we listen to podcasts or you're doing Google searches, you're now getting ads from the Walt Disney Company about making sure you vote for their board of directors, their slate.
That's right. You're hearing on Spotify, vote for a white proxy card. Like the Disney card is white, and Trian as well as Blackwells are assigned a different color card. And after Universal Proxy, all of the candidates will be on any given card. So it is really interesting the kind of social media tactics that they've done. Not only are they on Spotify, on Google, any kind of search engine that you use, as well as social media, like Twitter, Instagram, you're getting ads from them. And Disney is a very unique company where they have a lot of media IP, and they can use some of these to lure investors into or shareholders into voting for them. And that's why you're hearing this friendly Disney voice telling you to fight for the white proxy.
It's interesting. So we got the meeting next week, right? And it's interesting because this tactic seems much more targeted at the retail set than the institutional sets. Typically, we would just wait for ISS to come out with a statement that everyone would ignore, and the vote would go exactly as planned. You think it's going to be different this time?
So Disney actually has an unusually high retail shareholder base compared to some other mega cap companies, given its mass appeal. ISS and Glassdoor is already out. Interestingly, they have a split opinion this time where ISS is actually recommending 4 Nelson pelts and Glassdoor is recommending 4 all of the existing Disney nominees. So based on history, most institutional investors vote in the last 2 weeks. A majority of them vote in the last couple of days leading up to the vote. So right now, it will be a little bit early to call who is going to win, but we're about a week away from kind of knowing where this lands.
All right, Crystal C., thank you so much. Crystal C., of course, covering Disney and the activist investor proxy battle fight taking place there for us. And we'll be checking with her as we get closer to April 3rd. Now, part of the Pelt's proxy battle involves revamping operations at its Disney parks. Its peer, Merlin Entertainments, is on a bit of a revamp of its own. The company behind Legoland Parks and Madame Tussauds is buying the wheel at Icon Park and restoring it to its original name, the Orlando Eye. Joining us now for more is Scott O'Neill. He is CEO of Merlin Entertainments. Scott, great to see you here.
I'm thrilled to be here. Thanks for having me.
So tell us a little bit more about how the Orlando Eye fits into your portfolio.
Well, first, Merlin is not exactly the household name that you might find at Disney. But you might know our properties. And so Legoland Parks and Resorts, obviously we have 10 of those around the world, and we're building another one in Shanghai. And then we have resort theme parks. It's kind of a regional park like you would find in SeaWorld here or Six Flags. We have that in Europe. And then we have our gateway strategy, which if you think of London as an example, we have the London Eye, we have Madame Tussauds, 2 must-do attractions. In fact, 1 in 4 tourists that come to London come to one of our attractions. And then we have 3 other attractions there as well. So we're trying to replicate that strategy in the 10 most important tourist cities in the world. And Orlando, having 73 million tourists last year, is one of them.
Yeah, I was just going to say, it's a dense tourist city. How do you think about the distinction of the Orlando Eye versus the other attractions, Disney World, for instance, Universal, SeaWorld, everything else?
A rising tide lifts all boats. That's how I think about it. We have a wonderful Legoland resort in Florida as well, in that area. And so when you see investments that others are making, an Epic like Universal's making, or Disney's planned investment, and we're making in our Legoland resort, it's wonderful for Icon Park where the Orlando Eye is.
Talk to me about demand, and more importantly, the stickiness of that demand. We talk a lot about Disney parks and how no matter how much they raise prices, parents are still going to be forced to take their kids there, whether they want to or not here. How do you create sort of an ecosystem that has that same pull? The idea that is just so well known, at least to the children who might be driving this, that there will be no choice. It doesn't matter.
You know, we're really fortunate, because I feel like there's a big flight to quality, and Lego, the brand strength of Lego, one of the strongest brands in the world, is one that does get that pull. And that's from it. While the resorts are targeted really 2 to 12, we find more Lego adult enthusiasts there as well. It's been a good. In our room, we have 5,300 hotel rooms across our estate. Advanced bookings are in really good shape. And when you go there, it's a completely immersive experience. So I think that's what you're looking for now. You want to connect with your family, you want to create memories, and you want to have an immersive experience with a brand you trust.
Yeah, I was at Disney World right before the pandemic. I think I was the youngest person there. It was all like I'm exaggerating a little bit, but it gets to this idea here with your strategy at Merlin. Is it supposed to be kind of a destination the way that for a lot of people Disney World is, or are you going more for, I guess, a regional or local audience that's already there?
Yeah, slightly different. I mean, we have Blackstone and Kirkby, which is the family office of Lego, and CPPIB are our shareholders, and they're very focused on growth. Where they are concentrated more in 10 kind of locations, we have 141 attractions. And so you'll find us in 23 countries, so in 87 cities. And so it's definitely kind of we are where the people are, whether that's tourist cities or domestic attractions. Some of it are theme parks, very similar to our peers. But generally, we want to take brands and bring brands to life and get them close.
You're also rolling out dynamic pricing outside the U.S. this year, in the U.S. In 2025. Dynamic pricing or surge pricing kind of has a bad rep.
I know, and it doesn't deserve it.
Well, okay, so how do you propose making this palatable to consumers?
Well, here's the thing about pricing. First of all, we come out of a year in 23 where we had record top line. We added 7 million more guests. We had record number of consumer satisfaction and record, we measure value, price per value. And so how is that possible? Well, that's what demand pricing does, right? So in your peak periods, when you have everybody wants to come in those peak periods, we need to raise prices to keep the queues down, right? And when there's shoulder periods or off peak, we want to make sure that there's affordability for families. And so I think some of the negative connotation makes great headlines, but the reality is it's a wonderful tool for marketers and operators to make sure that you can enjoy this park 365 days a year.
You should talk to some of the people who own ski resorts, because
I should.
Like, last time I went skiing, I was like, literally, I was longer than the lines at Disney World. But it gets to a point too. Do the consumers understand that? Because as Scarlett kind of alluded to, when people hear that word dynamic pricing, they automatically think it's a loss for them in some way. How do you articulate what you're saying, that, you may pay more, but you're going to have a better experience?
Yeah, it's unfortunately, unfortunately, they often aren't as informed, which is so strange, because these are the smartest consumers in history. They actually survey the market, they temperature check, they price check really, really well. But the idea of people like me out articulating it and programs like this, giving us the opportunity to come out and explain it is a good step forward.
All right, Scott O'Neill, thank you so much for joining us today. Scott O'Neill is CEO of Merlin Entertainments. All right, let's take a look at how markets closed on the day. Remain not a busy day, not a big day. In fact, I'm fearful of saying it's not going to be a busy week, given that the most important data point comes out on Friday after the market's closed. Yeah, I mean, Good Friday, a holiday, market holiday here in the U.S., so no reaction to that PCE data. But you should point out, I mean, leading up to that, I mean, you do have a lot of Fed speak, you've got some other things that maybe could move the needle. But you know what, Scarlett, what if I told you this? Maybe the market doesn't need it anymore. I think that's a good way of putting it, because it's the final trading week of the first quarter, and people who've been long equities have done pretty well, so maybe they don't want to do a whole lot in this final week. Well, given the run-up we've had in equities, there's going to be some big rebalancing in a couple of days. That's fair. When is it, 31st? That's this week? Yes, that's this week. All right, there you go. All right, this is the close on Bloomberg. Time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Shohei Ohtani. The LA Dodgers set to speak for the first time since the gambling and theft allegations involving his interpreter emerged. That's according to multiple reports. He fired his interpreter, or I should say the Dodgers fired his interpreter, who's accused of using $4.5 million of Ohtani's money to pay off gambling debts. It'll be interesting to see what he has to say. Now, will he be speaking through an interpreter? That's a good question. He's going to be making a statement. He's not going to take any questions. So it's very one-sided. It's a one-way kind of conversation. Yeah, I'm only intrigued by this because I think everybody wants to know what connection he had, if at all, to any of these things, or whether this interpreter was just kind of gone rogue on his own. But tough spot for him. Obviously, probably one of the most watched people in sports, certainly in baseball. One of the most watched people in the tech space. And it's not necessarily Jensen Huang. Not necessarily Lisa Su. Hock Tan trying to make a name for himself here. Of course, he is the CEO of Broadcom, and he's making a name for himself for his pay. He got a $161 million stock award. That's a lot of money, Scarlett. It is a lot of money. Do you know how much that stock award is worth now? According to the Wall Street Journal, about $1.3 billion. Nice work if you can get it. Absolutely. Well, a lot of it, of course, is because Broadcom's stock doubled in 2023, and it's been on a tear. It's got the link to AI. In its filings, Broadcom did say that Tan's stock award is intended as pay for 5 years. So it's not like, it's just for this 1 year. Okay. You're rolling your eyes a little bit here. Okay, $1.3 billion divided by 5. That's a pretty good payday. Certainly is. All right, the final person we're keeping an eye on is Donald Trump. The former president's wealth hit a new record, $6.4 billion on paper, after closing a SPAC deal for his media company and getting his bond reduced by 68%. He spoke earlier today.
Greatly respect the decision of the appellate division, and we will abide by that. We'll put up cash or bond very quickly, securities, cash or bond, whatever it is. We'll put it up very quickly, and we'll win the case.
For more, let's bring in Bloomberg Balance of Power co-host Kayleigh Lyons. Kayleigh, the timing of this is pretty incredible here for the former president. Not that this is going to be cash or money that's liquid or immediately available to him, right?
Yeah, this is a 6-month lockup he's dealing with when his Trump media technology group actually merges with Digital World Acquisition Corp, begins trading under the ticker DJT tomorrow, will make him worth more than $6 billion, one of the 500 richest people in the world, but he won't actually be able to reap that reward yet because of the lockup, and therefore it won't be able to go toward things like paying his legal bills. But as you say, he did get a little bit of relief on that front today from the appeals court in the civil case. This is the fraud suit brought by the Attorney General in New York, Letitia James, which essentially said that he owed $454 million in damages to the state of New York. He was due to pay that amount today or post a bond for 120% of it. He said a number of companies rejected giving him that bond because they weren't accepting his buildings as collateral. And so the appeals court reduced that bond owed by about 68% today to just $175 million. He now has 10 days to pay it, and he says he will be using cash as collateral for that.
And we should point out, too, while there is a lockup period, Kayleigh, we do know there is also the potential for a waiver should the primary shareholders decide to give it to him. So in theory, he could sell soon. And one of his biggest donors, one of the biggest Republican donors out there, is also an investor in DWAC and has seen a pretty big payday himself, at least on paper. And it raises the question, Kayleigh, about this vehicle, DWAC or DJT, whatever it's going to be called tomorrow, and how much of that is going to be a factor in this campaign in terms of fundraising.
Well, it's a very good point, Romain. Jeff Yass, of course, who you're referring to, also one of the big investors in TikTok and is at the center of perhaps or questions around Trump's shift to no longer be in favor of banning that platform. But certainly we have to keep in mind that DJT, as it is known, this public entity that will be brought public, is the parent company of True Social, which is a separate platform that Trump owns and operates and essentially rules in order to disseminate information to voters, but more specifically his base that populates True Social, if you will, and goes there to hear from the former president for a variety of things. He certainly has been active on True Social today, not just talking about the civil case in New York, but also the criminal case he's facing there as well. It's worth keeping in mind amidst this spattering of Trump news we've gotten today. We also did have a hearing in the Alvin Bragg case, the hush money payments case related to the payments made to porn star Stormy Daniels. He's facing 34 felony counts in that case. And the judge ruled today that despite Trump and his legal team asking for a 90-day delay, that trial will begin on April 15th. So we're just weeks away from a historic first ever criminal trial of a former president.
It's scheduled to begin April 15th, but I feel like the possibility it could get delayed once again always exists. Is that your read on it as well?
Yeah, well, it's worth keeping in mind it was supposed to begin today, Scarlett. Instead, jury selection that was supposed to start today turned into this hearing about whether or not it should be delayed and to what extent. We did hear from former President Trump after Judge Merchant made this ruling today, essentially saying he's going to appeal because there were a number of things that were ruled on today, including the judge dismissing Trump's attempt to get this case dismissed entirely, and as well as to disqualify Michael Cohen, of course, his lawyer and former fixer, and Stormy Daniels from testifying in this case. So he could appeal those things individually. Unclear if that would be a successful appeal or whether that would change the timeline at all. At this point, it seems highly likely that things will move forward on April 15th.
All right, Kayleigh Lyons there. An update here on DWAC changing to DJT tomorrow here. Successful, finally, SPAC deal going forward after a couple of years. For all your politics news, stick around at the top of the hour. Kayleigh will be back along with Joe Matthew for Balance of Power. Meanwhile, here on The Close, we're going to set you up for what to watch tomorrow. And that includes, well, some earnings, maybe, out of GameStop. This is The Close.
Do they have earnings?
All right, the setup for tomorrow includes, well, earnings out of GameStop. They're set to report results after the bell tomorrow. Bloomberg reporter Bailey Lipschultz joining us right now for a preview of what to expect. And I was just looking at the Bloomberg terminal here, expecting to see a drop in revenue on a quarter-to-quarter basis. But believe it or not, they're actually expected, if you believe Wall Street analysts, and there's I think two of them covering this stock, they actually expect a profit.
Romaine, because it's the holiday season. So it incorporates the quarter through the end of January, a couple days of February.
Is that why when I was going through the Bloomberg data, they always had a profit in the fourth quarter?
Exactly. They're like, it's the first 9 months, it really depends on games and hardware launches, new systems, but it really will be all driven by the holiday sales. And they are expected to be profitable and cutting costs as Ryan Cohen tries to right the ship. The big question is, will they have an earnings call? Will they address anything with forward guidance? At least according to the real one analyst who follows the company, Michael Patrick, probably not.
Okay, so profitable on a quarterly basis, but maybe not so much on an annual basis. To what extent is this still a discussed, talked about meme stock that people on Reddit pay attention to?
Not as much as it was, Scarlett. I mean, they really do kind of shift their focus to the hottest thing of the day. We talked a lot about Digital World and DJT, Trump Media debuting tomorrow. It really just kind of depends on the news of the day.
Don't forget RDDT too. Now all the Redditors can just invest in their own.
Reddit, Astera Labs, it's really kind of
cesspool,
everything that they want to. So it's kind of like out with GameStop and AMC. For the most part, they're still holding on. That's why the stock still is detached from what fundamental analysts would argue it's worth. But I don't know, not as talked about as it once was.
And not as talked about, and it raises a broader question here about who's left in this stock and how much of a leash are they giving Ryan Cohen, because we've seen this before. Very short press release, very little on numbers, and if they do have an actual a call with investors, it's usually just, 5 minutes?
If that, really. And the big thing is the people who are still in GameStop are the people who bought it and have preached about diamond hands and don't really have plans to sell. So I would almost say when you look at the selling pressure, probably short sellers, probably some type of kind of gaming out the system with that, because it still is down about 34% in the last year. And some of these short squeezes are just kind of rallies that get set up by other hedge funds. I don't really see a lot of chatter. You don't really see a lot of flow on the likes of Fidelity and other retail brokerage.
So there won't be a dumb money sequel, right? No part 2 to that.
Yes, I guess there's no replacement for Roaring Kitty. He's laying low. All right, Bailey Lipschultz covers GameStop for us. Full results after the bell tomorrow. Full coverage right here on Bloomberg. As we set you up for some of the other big things to keep an eye on, that includes that Milken conference over in Hong Kong.
Yeah, and of course, Bloomberg will be all over that. So we'll have our anchors and our talent there interviewing some of the big names. And of course, that's the setup before the big Milken conference in LA, which you'll be attending.
There's also a UPS Investor Day tomorrow, and I know we're going to have a chance to sit down with the CEO at 3:30 p.m. tomorrow.
Yeah, Carol Tomei will be speaking with us. It'll be interesting to get her take on her efforts to right the ship, of course, after their labor issues last year.
Yeah, absolutely. And there's going to be a lot of economic data. We were talking a little bit earlier about whether there's going to be any catalyst for the markets. I don't know how much this is going to move the needle, but you do get things like durable goods tomorrow.
Durable goods tends to be pretty volatile, so I don't know how much people can read from that. You need to really smooth that out over a 6-month period. You also get the Conference Board's consumer confidence data, which will be interesting, especially since we have seen inflation start to pick up a little bit. The Fed's not too worried about it, but it's going to weigh on people's sentiment.
Yeah, the Michigan numbers were pretty decent. I wonder how the Conference Boards will differ at all. Obviously, they do their survey a little bit different, so not necessarily apples to apples. But if people are still relatively happy, isn't that good enough?
If they have jobs, then people feel good.
All right, and earnings tomorrow, including GameStop and a couple others.
Yeah, BYD, of course, the Chinese EV maker, which of course has taken over market share from Tesla. So that'll be a good read on EV demand in China.
All right, that does it for the close. We will be back tomorrow with full coverage of all those earnings and data points. But stick around, full politics coverage coming up after the break with Balance of Power on Bloomberg.